Hi, everybody. Welcome to another PFA investment update. My name is Sam Chaplin. I am joined by James Bradley, and
Hi,
we're going to
everybody.
get through another round here of an economic review, market review, and some stuff we'll be watching looking forward. We're going to jump right into something you might be seeing a lot of. This chart's going to show you how the word stagflation has showed up in the headlines and in articles in Bloomberg at an enormous amount lately. So we want to make sure you understand what stagflation is and whether it's a real threat or whether it's just some clickbait hoping to get you to click on some articles and read them. So stagflation is a bit of an economics boogeyman because it's a bad scenario where it's a period of high inflation as well as low growth. It's also marked by high unemployment generally. So that puts us into a tricky situation where the tools the Federal Reserve would use under high inflation would raise the rates, which would incentivize people to save their money rather than spend it, which cools the economy a bit. Problem with that is if you have high unemployment and you're raising rates, then it also makes it harder for businesses to hire people. Their cost of capital is higher. They have less free cash flow. So you'd end up having high inflation and low growth, which is a real bad situation. So we're going to first take a look at the growth outlook, both with consumers and businesses, and then we'll look at the inflation trends and how we're moving along there. So Jim can start us off looking at the S word with the consumer outlook.
Thanks, Sam. Stagflation. I'm old enough to remember when stagflation was a thing, and that happened kind of back in the 70s, and was typified by high levels of unemployment and also high levels of inflation at the same time. Before that, I guess people didn't think that could really happen, but lo and behold, it can in some situations. So are we there now with stagflation? Let's take a look at the stag part of it. Is the economy stagnating? And there's indications that kind of lead people to either side of that argument. If we look at, for example, consumer confidence, we can see that the most recent number is a little bit lower. There's been a little bit of a downtrend over the past couple of releases, but the index bottomed out at about an 87 in December and January, and that seems to be a little bit of a crater there. But when we compare it with what we saw in the financial crisis, it was down at 25 at the time. So I think, all in all, we're off of highs, but consumer confidence is still relatively well there. And on the right-hand side, we can see that Chase card spending has basically returned to its trend level. It's currently 9.9% above pre-pandemic levels from 2 years ago. And retail sales numbers continue to beat expectations. So again, not necessarily indicative to anybody who's looking at it at an arm's length that we're looking at, real stagnation. On the so that's the consumer side. If we look on the corporate side, one of the things that people are pointing toward is, with some degree of concern, is that earnings boosts, the relative amount of revisions to the upside that companies are making, has been coming down as well over the past few months. But it's important to point out that there's still earnings revisions upward that we're looking at, pretty significantly different than what we saw during a big part of the period from 2018, mid 2018 to mid 2020, where we saw a trend more toward earnings revisions downward. So sure, a little bit of a slowing there, but again, the revisions are still on the upward side. There's a lot of concern about, for this quarter that we're in right now, the fourth quarter, are we going to be able to beat some of those higher, revised upward earnings numbers? And well, so far, we're about in the meat of earnings season right now. But the answer seems to be so far, yeah. Current estimates show that we've got elevated GDP growth continuing pretty much through 2022. So one of the things that we've seen lately is a little bit of a downward revision to what some people thought were going to be the GDP numbers for the next couple of years, but they're small downward revisions, and they're coming off of really relatively high numbers. And the trend still seems to be that we come back down to kind of more normalized numbers, but normalized numbers that are at least as high as what we've been seeing over pretty much the past decade or more. Again, not really convincing us that that stagnation is really happening. And we're going to get our first look at the third quarter GDP a couple of days after we record this. We're looking at a number that for the quarter that we think is going to be relatively robust, upwards around 2.8%.
Yeah, interesting to see the categories here on the what contributes to the GDP as well, whether it's more workers in the workforce or them being more productive or just a higher population in general. So that wraps up the growth side of things. I'll give you a little rundown on the inflation side. And I'm sure everybody's seen some inflation as they go to the grocery stores and are shopping around. In the headlines, you might see a lot about CPI and the PCE. CPI being the consumer price index and the PCE being the personal consumption expenditures price index. You might be wondering, why are there two of these? Is it just to make things more confusing? But both track a basket of goods and how their prices change over time, but there are differences in how those baskets are constructed. CPI is based on surveys of what consumers are buying, where the PCE is based on surveys of what businesses are selling. Additionally, CPI does not count expenditures that are not out of pocket. So if your employer pays part of your healthcare, that's not counted in the CPI, where it is in the PCE. And I think one of the biggest defining factors too is the PCE is a little more dynamic in that it allows for substitutions. So maybe bread was in the index at first, but then it got too expensive. People stopped buying it. They start buying something like rice, and the PCE will reflect that change. And for that reason, it tends to be a little lower than the CPI. The PCE is the preferred index used by the Federal Reserve. So they target about 2% increases per year in the PCE index. They've been well below that for long before the pandemic, but well above those levels now.
You just created a vision in my mind about somebody trying to make a peanut butter jelly sandwich with rice.
Yeah, I don't know, maybe not the best example, but maybe a bacon hot dog, something like
that.
There you go. So we can see the prices are on the rise still, but at a slower pace. It's starting to round off at the top there. So when we look at it in context, though, one of the big problems is when you look at year over year price changes, we're comparing the prices right now to the prices a year ago. And it's just probably can all remember we're near lockdowns. People weren't out spending a lot of money. Demand was low, which means prices were artificially low. So that's what's called the baseline effect, in that it's not really fair to compare prices now to the baseline of a year ago, because those prices were a bit out of whack with where they would be in normal times. So this chart looks at prices today versus 2 years ago. To eliminate that baseline effect, you might see a lot of other scary headlines talking about inflation being like it was in the 1970s. But you can see here that the 2-year price changes are not nearly at the levels that they were near the 70s. And on the next slide, we'll see they're not even at the levels they were from 2005 to 2008. So we're not in unprecedented times right now as far as inflation by any chance. Unprecedented times for many other reasons, but inflation is still within a range that we've seen in recent history. It just depends where it goes from here.
So given all this data that we've just gone through, Sam, I want you to tell us, is stagflation going to happen?
Oh, wow. Really going to put me on the spot. Some of the most polarized conversations you'll see out there right now. I mean, everything's a little bit polarized right now, but if you go online, you're going to see some people saying, we're going into hyperinflation. It's already happening. And you're going to see some people saying, the Fed's going to hike too soon and we're going to have deflation. I think with anything, the truth is somewhere in the middle. So can't take a whole position on that. All we can do is watch the data and not let the emotions take hold and let them polarize us even more.
I think you're right. There's plenty of our people on both sides of the argument right now, but it certainly does get a lot of attention. So we'll pay attention to it too.
Team transitory versus team structural is how you'll see it on Twitter. Everybody's got to be on a team now, and everything's either a crisis or a great something. Great reset, great recession, everything. So that wraps up the conversation about economic growth. can move on to the market review, where Jim's going to start off talking a little bit about equity valuations.
Sure. And, for those of us who watch these quarterly commentary pieces routinely, you'll get used to the fact that we really focus a lot on valuations, and valuations aren't just necessarily a raw number, but, how prices of stocks or any type of investment relate to the amount of earnings that you get from those. And, the higher that valuation, arguably, the scarier we get, because it's basically getting us a lower yield on the investments that we're making. So if we look at the S&P 500 index, it's a little bit of a busy graph, but the S&P 500 index is the blue line here, the price to earnings ratio for it. We can see that's crept up. It was pretty high in late 2020. It's come down a little bit, but still at 21 and a half roughly times earnings. That's a little bit higher than it's been historically. It equates to somewhere around a 4 to 5% earnings yield on those larger cap stocks. But if you look historically where that line has been, it's typically been below the other two lines, the teal line and the black line, for a good long period of time. But now it sits above those lines. In other words, valuations on large cap stocks are higher than valuations on small and mid cap stocks. Not always the case typically, and something that really catches our attention. And in times like this, when we look at those small and mid cap stocks, arguably trading at valuations lower than they historically been, it certainly gets our attention. It's not going to mean that there's going to be outperformance in small and mids right away off the bat, but it certainly gives us a little bit of a tailwind in that area. And we go to the next slide and look at where the overall market is valued. This is Morningstar's assessment of, is the market expensive relative to fair value, or is it cheap? Well, we can look at the fact that back in June, in that upper left-hand corner of that grid, it was showing that the market, by their estimation, was about 4% overvalued relative to fair value. And we kind of follow that arrow up to more recently, the September numbers. The same exact number. Morningstar was thinking that the market was still a little bit overvalued. Market kind of crept back a little bit since then, and up to today, it's back up to where it was. So arguably, if they ran the numbers today, they might say the same thing. But what's really changed in that short period of time is that part of the market, the growth part of the market, this is perhaps to name companies, Amazon and Google and Tesla, those are arguably more overvalued than they were back in June. Whereas, the value side of the equation, the old-fashioned, Johnson and Johnsons of the world, or Procters and Gambles of the world, are arguably priced more cheaply than they should be right now relative to where they were. So more value has been created on the value side, and more kind of overpricing, at least from Morningstar's standpoint, on the growth side. And so people looking to deploy assets now might find more of a tailwind on the value side. It doesn't necessarily translate into immediate returns up or down, but it's something interesting to take away from it.
Yeah.
If I were to, to hand it over to you, Sam, I'd be looking at, a little bit of validation of what we're looking at there from a standpoint of growth being more expensive and value being more cheap. I think you've got it for us.
Yeah, that's exactly what this chart is confirming here. Kind of the same theme of value being above where its trend levels were before the pandemic, as far as valuations, where value is much closer to being back in line. There are also some reasons that value does tend to perform well coming out of recessions. Includes a lot of financials and energy companies, which do well in those time periods. They've certainly been doing well lately, but according to this chart, there might still be some room to run on that side, in that category of equities. Another way we can segment out the market is by looking at global valuations. We tend to hone in, as most U.S. investors do, on the domestic side of things, but it's important to look at the rest of the world's valuations and seeing how we compare. So similar, this is on a trailing basis, PE here. U.S. In the blue line is at the highest valuations by far, and you can see that spread between U.S. and international developed in the teal line is about as wide as it's been in quite some time before the pandemic, meaning that, either U.S. stocks are expensive or international are cheap. There are certainly some reasons, based on U.S. monetary policy and everything we've done here stimulus-wise that put a lot of money into the system, that U.S. stocks might be more expensive. You can also take a look at the gray line there, which is the emerging markets of the world, which are even cheaper than the international developed and the U.S. stocks. It's generally, as you can see, the trend is for that to be the range. It goes U.S., then international, then emerging markets. But what's interesting here is the spreads between the U.S. stocks, valuations, and the internationals. So something to keep in mind there.
Switching over to the bond market, some people say that that's the smart money is on the bond market side, while the irrational kind of crowd mentality is on the stock side. Who knows whether that's really the case? But if it is the case, and we look at relative movements of investment grade debt versus riskier credit, the high yield stuff, over the past year, they've traded in roughly the same pattern. And so, bottom line is it's still really kind of hard to find yield in the bond market, and arguably a lot of the safe stuff is yielding negative numbers on a real basis when you adjust for inflation. But the relationship between the two has kind of stayed steady, and that's potentially an indication that the market sees credit risk as not growing, and that's usually, if we do see credit risk growing and those spreads widening, that's the bond market looking at rocky economic times ahead. It just doesn't seem that the bond market is seeing that the way it's priced right now.
Yeah, that seems to be the case. It's difficult allocating assets right now with interest rates as low as they are. Some people saying, the 60-40 is not working as well right now as it has in the past, and you have to look for alternatives, which is something we've been doing for quite some time, but certainly be watching credit risk and interest rate risk on the fixed income side as opportunities present themselves. So one of the biggest unknowns right now looking forward is labor market recovery. Currently the percentage of eligible Americans participating in the labor force stands at 61.6%, which, as you can see in this chart, is pretty low relative to recent history. Haven't seen levels that low since 1976. Seems to be a big, kind of reset going on with people considering their work-life balance and what the value of work is. For the first time in a long time, it appears labor kind of has the upper hand here, at least the, suppliers of labor versus consumers of labor, and they're definitely exercising that right. You've seen salaries and wages come up in reaction to that, trying to attract people back to work. A lot of people have thought once the federal unemployment benefits expire that we'd see a big rush back to work, and we haven't really seen that yet. And we've seen high amounts of people quitting jobs. Also very polarized expectations on or people's thoughts on why that is. But at least for the moment, people are using this pandemic to fight for better wages and working conditions. So how that moves forward will be very important. As we saw in the GDP graph earlier on, population growth and worker growth can be a big portion of GDP. Right now, the U.S. is pretty slow population growth going forward. So if people start falling out of the labor market at faster than expected rates, then that could be a big problem. Especially women, unfortunately, have been falling out of the labor force at higher rates. So that's the labor market looking forward. Another thing we're watching is rate hikes. So the Federal Reserve can raise rates to fend off inflation. This chart shows how people's expectations of rate hikes have changed throughout the year. Where they thought rates would be at any certain part. You can place bets on that in the markets. That's how they drive these numbers. But anticipation is that to be almost 4 rate hikes by the end of next year. It's a lot faster than we initially expected, generally in reaction to higher than expected inflation numbers. The tricky part here is that the risk of not raising rates fast enough is inflation, right? Raising rates cools the economy, incentivizes people to save, overspend. kind of slows down that velocity of money and will generally quell inflation. However, the kind of dangerous side is if you wait, or if you hike rates too soon, you'll be squashing that demand at the same time that all these supply chains are coming back online. And we could end up with the exact opposite problem we have right now, which would be too much supply and not enough demand, which could actually create deflation, which is, counterintuitively actually more dangerous than inflation itself. So it's a bit of a balancing act going on with the Federal Reserve right now of timing when to raise rates. Certainly going to be something we watch going forward. And Jim will talk a little bit more about those supply chain disruptions.
Yeah, this is a picture that's probably familiar to a lot of people. We're seeing a lot of backups at ports around the world. It's led to long wait times and higher prices for imported goods. A lot of times you'll hear the kind of the glib phrase that the cure for high prices is high prices. So as bottlenecks kind of drive prices up, and that can have the impact of curtailing demand being curtailed actually brings down the prices again. It also allows for opportunities for more providers, more suppliers to get into the picture and try to find ways around these bottlenecks, which also is kind of its own cure in and of itself. So we're optimistic, I'd say, and you probably join me, Sam, in being optimistic about the fact that the supply chain disruptions that we're seeing right now are going to be resolved, and they're probably going to be resolved at in a time frame that's kind of on the not quite as long as I think some economists are predicting, but it's really kind of hard to tell exactly how long that's going to be, and it's still likely by most accounts to get worse before it's going to get better. So Sam, the one thing I'd recommend for you is that to the degree that you're going out doing shopping for my Christmas gift, I would like it if you would get right on that soon, because it could take a little bit longer to arrive.
Yeah, great advice. Thanks for that. Great. Well, that about wraps it up. We won't see you until next year. So hope everybody has a happy holidays and gets to see their family this year and enjoy the time.
Enjoy your holiday season, everybody, and we'll see you again in 2022.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.